I'm Jared Johnson, and on this episode of the Stock Market Playbook, we have Ben Kizemchuk. It's a amazing episode, probably one of the episodes I've enjoyed the most. We talk about the mechanics of the market and where things are and why things are where they are at this current moment with the AI trade and with the S&P where it is and with all of the volume that we're seeing. I love this episode. I think you will too. Enjoy. Take it away, Ben. Okay, Ben, thanks for joining us on the Stock Market Playbook podcast. We're glad to have you with us. You're joining all the way from pretty far north and pretty far east for me, right? Up in Canada.
Yeah, that's right. Nice to meet you, Jared. Thanks very much for having me on today.
Yeah, we're happy to have you. I think there's a lot of interesting market themes that are happening right now, and a lot of good things to cover. So I'm looking forward to our discussion coming up. But before we dive into all of that, tell me and tell our listeners a little bit about yourself.
Yeah, sure. So I'm a portfolio manager and investment advisor at a firm in Canada called Wellington Altus Private Wealth. I have been in this industry for years and years and years. I'm the guy who started in the mailroom and worked his way up through the ranks over time. I think it was like a summer position. I finally was able to get in that mailroom years and years ago. But before that, I had the really good fortune of growing up in a family of very passionate investors. So I remember having conversations with dad, around the dining room table as a young kid about investing in companies and like Pepsi and things like that when I was like a kid. And I was more interested in Pepsi as the company than like the soft drink. Um, and then also my uncle, who in his own right, has opened my eyes a lot to the ideas around systematic investing at an early age. So I really feel like I've kind of grown up in this world, and I've been working now with private clients since I believe it's 2010. So coming up just over 15 years now, working with people. Generally, my clients are about $1 million of net worth invested with me. And we're managing all sorts of portfolios from growth to income and also some alternative investments as well.
Gotcha. Very cool. So, with your clients that you kind of help manage their funds, are you more in the allocation space? Are you doing some of the investing yourself? How's that situated?
Oh, yeah, great question. So prefer to do most of the work that we can do in-house ourselves. So in the growth portfolio, that's where we're focusing primarily on single stocks, very concentrated positions. We're owning only a small handful or two of companies. And I mean that quite literally, concentrating in maybe 10 to 12 names that
Yeah.
we feel very strongly about that really meet a very specific set of criteria that we look for in companies. And then in that income portfolio, that's where we're doing more allocation-based work using ETFs, trying to get more diversified exposure to broad themes and markets. And then we also, we use some outside third-party managers as well where it makes sense. That's really just stuff where we understand the strategy, we like the managers, but it's just very intensive work that we can't do ourselves.
Yeah.
So, for example, like merger arbitrage type ideas, very difficult to do that here for private client accounts. Prefer to do that. Let somebody else manage that for us.
For sure. That's a difficult side hustle for sure. So
Yeah, well said. Yeah, exactly. Yeah.
That's great. So, so in your growth side of things, you guys go pretty concentrated. You look for a small number of, hopefully some big moving, successful names. What are some of the things you guys look for when you're thinking about, allocating some money in that space?
Yeah, so really that is a very systematic process, very rules-based ideas there. This is kind of coming out of my history of an experience of investing and really wanting to stick to things that you're good at and repeatable, right?
Yeah.
So we're looking at concepts like trend and momentum. So you want to buy something in an uptrend. Generally, things that are in uptrends continue in uptrends. That's kind of the very simplest way of thinking about that. I don't mind some volatility because that's the nature of growth investing, but you really want to try to control for volatility where you can. So measuring realized volatility in a few different ways to kind of try to smooth out those uptrends is generally a good idea. And then also trying to purchase those uptrends and avoid kind of flash in the pan dynamics, so to speak. So you want to buy an uptrend that has some durability to it. And the best way to assess that is that there's some sort of underlying cash flow idea happening, right? So either the free cash flow is increasing or cash flow from operations, but there's some sort of aspect on the financial statements, preferably an actual, like cash that you can count, not necessarily earnings upside. So for some companies that makes sense. But really looking at cash flow perspectives in terms of making sure that those companies that we're purchasing are going up for the right reasons at the end of the day.
Yeah, it's always an interesting thing because in the long term, I mean, a lot of the stock market in general has an uptrend, right? And not every element of the stock market, stays true to that. And so, finding a couple of these solid financial metrics makes a huge difference for the long run. And certainly, increases your odds of a continuing uptrend. Now, when you say that you guys try to kind of manage the volatility, do you do that strictly through kind of financial metric side of things? Do you guys use any options or anything to kind of help control that?
Yeah, so we don't actually use any options or leverage in the portfolio. So what I'm doing for my clients is strictly long only investing, right? It's very simple. There's a lot less moving parts. There's less mistakes to be made, right? If you get
Yeah.
the options part wrong, you get that very wrong and ultimately ruin what could otherwise have been a very well-run portfolio by miscalculating strikes or you don't get the volatility picture exactly right. So I've tended to steer away from those overly complex kind of measures of risk management in a portfolio. For me, the easiest kind of way for us to manage those ideas is quite simply by using stop losses. And I'm not talking about like a stop loss like that sits in the order book. I mean, I'm not into getting hunted, for that kind of stuff.
Sure.
That's like a very real risk, right? But the idea is that when you're purchasing something and you're buying it because it's already going up, where trend or momentum is an important factor of why you're purchasing something. If that trend or momentum stops or stalls, or even worse, starts to reverse, it's no longer fitting the criteria, right? And so the way that we look at it, we'll set a stop loss or a paper-based stop loss in each position that tends to be, related to that position's natural volatility, so to speak. And if that is breached for whatever reason, I'm on the line with my trader to get the position off, right? And I don't care. Like I've been doing this long enough that I do not care what the reason is. To me, our ultimate first goal is to protect the capital. Our second job is to grow it. And so if something's moving against me and I may not understand why, I don't care. I just want to get the position off to protect the money. I can always reassess and buy back if I want, right? So the idea is that you want to protect that money at the end of the day. Now, that's kind of like once you're already in a position. Secondarily to that, there's kind of like a bigger picture kind of risk framework where we're looking at some other inputs into markets, which can override just the idea of purchasing stocks in the first place. Sorry. So the idea there is that, for example, the latest time we've done this is going into Q4 of 2025. We lightened up our positions entirely in the equity portfolio, and we are holding bonds, right? Quite boring, like short-term treasuries, and we ended up purchasing some tips in there. And the idea there is that although our preference is to be owning individual, growth stocks in that portfolio, if we don't see an environment that is conducive to growth stock investing, and that is determined by some other metrics that we're looking at, then we simply just won't own those growth stocks. We're just going to hang back and own treasuries or own some or cash potentially, right? Something that isn't stocks, so to speak, but that doesn't necessarily increase our risk curve. So we're not just going to automatically go to like commodities or something like that, where where you could still compound a lot of risks if you're dealing with that kind of end of cycle activity.
Sure.
So that's currently in the growth portfolio as it stands right now. We're currently still positioned in those bonds, just kind of waiting it out and just being very patient until some of the things that we're watching change up for us.
That is the interesting kind of point right now is there's, we've seen so many movements, in a lot of these growth stocks and a lot of these, obviously the AI play has been massive. And, obviously people were watching very closely NVIDIA's earnings yesterday and they just they killed it. They blew it out of the water. I mean, these year over year growth metrics that they're showing are ridiculous. And Nvidia's down 1%, right? Like, okay, has expectation begun to outpace, the actual reality of everything? And this is, it's so funny when I bring guests on the podcast and we talk, specifically about some of these some of these AI stocks and chip stocks and so on. I've had a few people say it's the only place you should be invested at all. Just sit in there, write it out. And then of course there's people on the other side saying it's a played out trade, at least for the near term. I think it's pretty safe to assume that there's probably a lot of upside to these stocks over the next 3 to 5 to 10 years, whatever. But I think everyone's very, very interested and curious and cautious about the next, I don't know, 6 months, right? How did these kind of trades play out? And it's interesting that you guys are kind of, on that growth side of things or on the sidelines a little bit, waiting for what we like to call coming back to reality just a hair, possibly. It's interesting.
So the idea there is, first off, just in terms of Nvidia and earnings reactions, I mean, so much of this now has to do with options activity, and in terms of what the options activity is that is leading into these earnings results, that a fair bit of this reaction that we're seeing today could simply be because all of these calls were purchased ahead of time, and the calls are just not working, and it's keeping a cap on Nvidia. And even though the results were better than expected in some case, in Nvidia's case and some other companies, the options positioning running into these things are forcing dealer hedging requirements in certain ways that are creating, maybe let's call them unexpected results with the stock prices, even after good news comes out, right? And this has been a growing and stronger effect in the market, I've noticed, over the last maybe 6 or 7 months, going back to maybe September, October of 2025. Mm-hmm. And I think ultimately a lot of this is all very downstream of money creation that's happening in what I've kind of understood as a contraction in flow into the market. And I think a lot of what we're seeing right now in terms of Mag 7 trade, in terms of S&P 500 trade, in terms of AI and chip stocks is actually downstream of all of this kind of money creation idea, okay? So to put it a little bit more succinctly, going into the end of 2025, we saw a contraction in year-over-year deficit spending coming from the fiscal side of things, okay?
Yeah.
That just recently now has started to correct. So now we're actually kind of level for year-over-year going back to 2025. But there's been a lot of cumulative kind of effects of lower deficit flow going into the economy. So the deficit is still positive. We're still generating that flow, but it's a lot less than it was in 2025. And that's had a relatively, not in absolute terms, but a relative terms, contractionary effect. There's less money flowing into the market, okay? Now that had the immediate effect over 2025 and 2026 thus far of, in my opinion, limiting the amount of money that is flowing into equities, okay? On top of that, the other source of let's call it credit creation is obviously credit coming from banks. And that large source, the biggest area of growth there was money going into non-depository financial institutions, which is like private credit and AI hyperscalers and AI capex growth, all that kind of stuff, all kind of muddled into one. And that had been really the largest engine of growth for credit over the last few years. And just recently, it looks like that has started to inflect lower. And I mean recently as in like over the last like month and a bit. Okay, and that's just coming from the weekly Federal Reserve reporting, right? Every Friday they issue the reports at end of day. And these two things have had kind of the combined effect now of this kind of contractionary effect. And how I think this is kind of played into markets now at the S&P 500 level is there's less inflow going into the S&P 500, into passive investing, because a lot of this money gets channeled into passive, right? Mm-hmm. In my opinion, that's one of the reasons that we have seen the Mag 7s trade so weak relative to the S&P 500. Like if you go back to October 30th or 31st, 2025, that was kind of where the Mag 7 peaked. And if you go from that day to current day, this is May 21st right now, the S&P 500 has outperformed the Mag 7, right? If the Mag 7 is the first place where money flows into because of passive effects, right? If most of the market is passive and money goes into passive and passive goes into Mag 7, and Mag 7 yet is lagging the rest of the market, that implies that there's less flow going into the market. And that's what we're seeing here. Where this plays into now in terms of what you mentioned about the chips and NVIDIA and the AI basket, is you still have this this bolus of liquidity floating around through the market. It's like a hot potato, right? And we saw it over the last number of months leave Mag 7. It went into staples. It's gone into utilities and out. It went into the precious metals trade and then had fallen out of there. It had gone into energy. It's still kind of muddling around in there. But the place where it's concentrated at this very moment is it's all flowed into that AI trade and into chips, right? Flowing back to a moment ago, you mentioned that you had a guest that talked about how important it was to be part of that trade, right? That's where the hot potato is landed now, right? And the idea there is these stocks that received that bolus of liquidity floating around, they don't have infinite liquidity, right? These are constrained. There's a limited number of shares of these things that are available to be, traded by the public, like a free float. Like passive owns some of this, and then there's this kind of active portion. And depending on where that liquidity flows, some of these stocks or sectors are able to accept more or less of that liquidity kind of hot potato running around. One of the things that I think I'm looking for here, and a lot of people are looking for here, is we've seen this liquidity enter the semis, okay, semiconductors. What happens if or when it leaves, right? That's the heart of the AI trade. You are now in the heart of AI in those semis. And that's where liquidity is right now. If that bolus of liquidity leaves that trade, where does it go next? That's a big question. But what happens to the S&P 500 when that leaves? All right, like that's the zeitgeist. Okay, that is the quintessential 2026 idea. Is what happens if that leaves, and it can.
Right. That's an interesting take because we certainly have seen that. We've watched, NVIDIA and so many of the Mag 7s underperform some of these other chip stocks and semiconductors and so on. And some of them are up huge amounts, right? And that's an interesting take, that ball of liquidity that's floating around out there and what happens. And I mean, I think with AI being such a force to deal with on one side, and with option volatility being this other thing that gets attention on and off on the other side, it does make me wonder, have people begun to accept the excessive amounts of volatility that comes with some of these stocks? So, for example, when that big surge of volume leaves inevitably, which it always happens in the market, right? There's always a lot of volume and volatility kind of floating around out there. When that leaves the chip stocks, I mean, it is interesting, but also our traders, is that the price of entry? Is that the price to play kind of a thing, right? Are we going to see a huge crash, and are we, not a huge crash, right? But a big sell-off in that space, and how are traders going to deal with that, and are they positioned accordingly, and and will that sell-off be exaggerated by the option activity that is probably attached to those stocks currently?
Well, I think that you're kind of setting up the conditions for exactly that. I don't want to use the C word, okay, because that's a very loaded term, and a lot of people can take that term and run with it. And so if you and I start throwing that around a little too casually, we're going to end up with like millions of Twitter people, beating up on us, right? But let me put it this way. Okay, so what I see coming from the April rally into present day is a market that has been working under this kind of contracting liquidity. That contracting liquidity, especially in the active manager sense, like if you look, there's been a lot less dark pool activity. There's been less institutional buying. We've seen less unit creation of ETFs, et cetera. That to me implies that there's less institutional sponsorship or participation in this rally that we've seen over the last number of weeks.
Yeah.
Since there is less volume and liquidity being provided from these institutions and inflows, that has left the market to the winds of these other types of flows, right? So in this case, hedging flows coming from options dealers have now played a greater role in markets because there's simply other people are not trading as much. So the slice of the volume pie is shrinking because there's less inflows and less flow going into the market, but also the relative size of the slice that options dealers occupy is growing larger because that's the only activity that's kind of being left. There's some systematic trading, but that a lot of those flows were kind of over and done with within like April, like a lot of CTAs and stuff that got triggered early on in that rally move. They got fully allocated more or less, and now it's just been this real options-driven market. Okay, now the issue with that it is like that's always happening in the background, and that's been happening in markets for a very, very long time. But now that the market has been primarily driven by this options flow, in my opinion, we've seen what I would characterize as a gamma squeeze. Okay, so that is where a huge amount of call options has been purchased relative to put options, right? The cost to insure the upside of a portfolio is now more expensive than to insure the downside. And if that sounds kind of nutty, it is, okay? And there's a lot of different ways you can measure this, but lo and behold, we're at this junction right now where this huge surge in call option buying has driven the market up to about 7,500, and it kind of turned on a dime right at 7,500 because there was this other pocket of options activity at that strike, which would have caused the market to turn around because of how dealers have to hedge at that level. Okay, so we got to that level, and now we've turned abruptly back lower. We are in a broader situation right now, which you could kind of characterize as spot up, vol up. Okay, so that means the index is going up and volatility is also going up with it. That again is not really characteristic of how markets usually work. The last time that we have seen this, like spot up, vol up tends to happen from time to time. But the last time we've seen it persist like this, okay, in this current form where we've seen like a few weeks of this kind of activity, bad things kind of happen next, okay? And I'm not saying that it has to happen. I'm saying that the conditions are there where bad things can happen, and they can happen very, very quickly, okay? One thing that I look at here is, you know, for example, you can look at the left tail volatility index, which is a really interesting like CBOE index, and it tracks kind of activity at the far left tail of what happens for options activity. And the stuff is like at bargain basement lows, right? And it can hang out there, it can stay there. But if you look at this thing over the last number of years, this is like we're at extreme levels. So either we are entering a new regime for volatility, which is possible, you could do that. It doesn't feel that way to me, right? I'm looking at you know, valuations out there. I'm looking at the flow dynamics. It feels to me like we're still sort of stuck in this regime we've been in the last 3 years, and in which case I would say that that volatility pricing is incredibly cheap if that's still the regime we're in, or if we are in this kind of new world where the administration can successfully jawbone its way through every single issue henceforth for the rest of time, then okay, that's an interesting world to live in which case, you know, the options might still be too expensive. I don't know, right? I think it's more of the former than the latter, right? I don't think we're living in this entirely new world yet where these techniques can forevermore be successful at controlling volatility.
It is interesting in the stock market how historical norms evolve a bit, but not typically a ton, right? I mean, what we see Because at the end of the day, we're dealing with our own money, with other people's money, and everything always gets to a point where it no longer makes sense, right? And so you have to ask yourself the question: is this a new regime? Is this a new way that we are managing the financial markets, or have we just hit super hype and it's time for some correction? Right? It's time for some correction. One thing that that I love to look for in my in my own trading and how I invest my fund is, we have a lot of metrics that we look for. We do a fair bit with options, but at the end of the day, when I have everything lined up, right? Because we're not ultra long term. We're not typically on the buy and hold. We're more of, let's be in something for 30 to 90 days. Really is kind of our window for our hedge fund. So what I need to see is a lot of things in line, and to build my structure around that. But ultimately, I need to see some sort of a catalyst, some sort of a match on the gunpowder that's going to get things going. If you had to say the catalyst that that could prove that we're not in a new regime and that maybe it's corrective time, right? That it's time for to ensure that portfolio, buy some puts, do whatever it is we're going to do in that space. What is a catalyst or two or three? I mean, what are some that you're thinking about? What's going to be the thing that kind of pushes the market into that? Okay, time to face reality.
The realization phase, right? Okay, so first off, the way I'll answer that question is I think I don't really spend a lot of time looking for catalysts. I appreciate them and I love it when they show up. But for me, I really, maybe it's because I'm a slave to the systematic approach, but I'm looking for the conditions that are so catalyzable, if that's even a word, that they could even form their own catalyst on themselves, right? So something that has such strong momentum already that the catalyst may have already been realized, but I'm just surfing that wave for the next few months, right? So I'm looking a little bit longer term when we're picking up positions here. But in terms of what could ultimately form a catalyst in the near term, I think that ultimately, energy production issues. It's no secret there. We've knocked a lot of capacity offline. We're going through storage right now, left, right, and center, and you can do that for a while, but eventually you have to face the reality of it. When you're dealing with commodity markets, just dealing with the commodity cycle and the inevitable overinvestment that happens tends to be its own kind of catalyst in a way, right? Things get priced out of a portfolio, or things get priced out of capex. Capex cannot continue at that rate because the sustainability of capex comes into question, right? You can't just spend infinite money because there's not infinite debt to pay for it with, right? You just can't. You hit a limit.
Wait, this is 2026. There is infinite debt. Isn't that a thing?
We're still working on it. Yeah. Yeah. And so I think there are no exponential curves in investing. There are logistics curves. There are things that feel exponential at the time, but ultimately everything is self-limiting, right?
Yeah.
Ultimately, you do hit these growth limits, and you don't even necessarily know that you're there at the moment. Like sometimes it's only in hindsight that you realize that it's a self-limiting curve, right? So one example of that right now, for example, is looking at just take back specifically to like equities, is you look at like margin facilities from FINRA, right? Okay, so every month FINRA reports what's the margin facility that's being used. So year-over-year growth going into April is something like just over 50% year-over-year growth in the amount of debit balances being accessed. Okay, now the market is up a lot over the last year. Okay, but as time rolls forward, a lot of that margin facility has been more recent. It's been added more recently. Okay, so what is the return on that margin facility, right? If it does not keep pace with the same growth as margin lending, then that margin lending doesn't make sense anymore, and you can't service the debt anymore. It doesn't make sense, and you start to contract your margin facility. That's the kind of thing that happens at a top. Okay, so that's kind of what I mean by the logistics curve and things being self-limiting. That's a really good example of putting out a growth expectation that in itself will be limited by its own use. Okay, so the overuse of margin kind of extinguishes itself in this case, or at least it has historically, and you end up forming a major top.
This is a little bit of the essence of the stock market, right? Is you get these runs, whether it's an individual stock, an index. I mean, if we look at the S&P 500, the SPX, we see this massive run up. We see this massive run up on so many individual stocks. And these catalysts, right? These reasons for tops are kind of self-fulfilling prophecies, right? Because we're there, something is going to tip it. It's really just, it's not that the market cares so much what the thing is. It just needs something that has enough consequence, right, to not correcting, or something that people pay enough attention to, or whatever the case may be, to kind of, tip it off of its perch, which can get so high. I mean, in the simplest form, right? If we're not even looking at any financial metrics or aggregate earnings of like the S&P, if I just look at a chart of the S&P 500 and I say, geez, right? This thing is, especially the run since, since the last dip over the past year or so. I mean, it's massive, right? If we look at any kind of, again, keeping it so simple, and this is where I'm saying kind of this self-fulfilling prophecy side of things. If we look at a 1 year, 3 year, 5 year, 10 year, 20 year chart of the S&P, we see that in every instance, it's at least 2 standard deviations above the mean everywhere, right? If not more on some of the lower time frames. And just something like that means, okay, are we going to see 3 standard deviations? Are we going to see 11 standard deviations, right? Like, where does this stop, right? And so even something as simple as, okay, how extended are we in one direction or another? Markets are very kind of elastic in that way, right? And we can always dig under the surface and find those reasons why that is. But I've always just watched some simple things like a standard deviation move, or some of these, mid to long term average prices, and kind of where everything is in relation to that. And the ball of yarn starts unraveling at some of these really aggressive levels. And so when we see, the S&P 2 standard deviations above the mean, I mean, that's pretty significant. That's typically a point of, best case scenario, a lot of consolidation, right? That's kind of, it's hard to do much beyond that.
I think in the short term, you could certainly see that type of consolidation activity happening. Like in my own personal view, I think, we could see, a 20% correction from here, maybe up to 35% into latter part of 2026. And I wouldn't be surprised to see something like that unfold. However, I do think that ultimately we are going to keep seeing, in fact, an escalating or increasing upward trend for the S&P 500. And that's simply because of the way the index is constructed and the passive inflows that are running into that index, right? As those, right now, passive is something like, 50, 55% of daily trading activity, something in that neighborhood, right? Notwithstanding what I just mentioned before about the inflows kind of contracting a little bit over the near term, we're still kind of in that range, okay? Ultimately, I do think that the U.S. economy keeps growing, and therefore that those inflows should continue. There's going to be more nominal money creation from fiscal and credit over time, and so that will all kind of congregate, so to speak, into the S&P 500. And there's almost like this Cantillon effect that happens, where the stocks that are closest to the flow get most of that money. So the Mag 7, right? I think over time, we are going to see something like the Mag 7 becomes the Mag 6, then the Mag 5, and the 3. Like as these kind of monopoly effects start to happen, both at the economic level and at the investment level, right? As that money flows into these companies and lowers the cost of capital, lowers the cost of equity capital for these companies, right? There's more and more flow going into them. Just that very simple mechanical effect will have the ability to raise the weights of these companies within the S&P 500 relative to, stock number 499 or 500. And that is going to force the S&P 500 to trade further and further away from its moving averages, and in this case, increase the standard deviation from those moving averages. Ultimately, that will look like some sort of exponential. And going back to what we said a moment ago, it's going to be logistic, guys. It's just we don't know exactly how, but there's no such thing as exponential growth in markets. It's always going to be logistic, so it's going to end somehow. We could talk about how it ends. I have my views: increasing state participation in equity markets. Maybe it becomes state-run at some point. Who knows? But something at the end of the day has to solve that issue. We're not there yet. We're at the very beginning of what that issue looks like. Now, I think right now, people are just starting to understand these impacts of passive. There's been more people writing about it, I've noticed. There's been more general understanding of these concepts that are entering kind of like the public domain. We are still in the very early stages of it. And my hope is that this becomes a more public part of the discourse, that is not just like two financial guys talking about this, but that this becomes something that regulatory agencies and lawmakers start to understand, because it is, in my opinion, having very real impacts on the retirement purse, right? Like, this is people's retirement savings at the end of the day, and we have to understand what impacts these legislative changes have had on that, and but both the good and the bad.
Interesting. These are these are all very interesting points you're making, and I love it because, again, not a lot of people are talking about some of these things that are so important to the underlying mechanics of the stock market and what keep it going and moving and so on. Because at the end of the day, we're all just a bunch of, as one of my old trader buddies used to say, degenerate gamblers, and we just want to make a bunch of money, right? but there are real consequences, and there's real mechanics that have to keep this thing from from coming off the rails. And so those are great points. I love what you said about all that, and kind of how we see this evolving as we go. I think it's going to be a very interesting second half of 2026. I think there's I think a lot of if seasonality is even a thing anymore. We're headed into summertime. We get to that infamous worst month of the year in October, where everything goes crazy, and are we going to get a strong end of the year? How does this all shake out, right? And so I think understanding a little bit of what we're working with and making sure that you're positioned correctly. I mean, the fact that you guys are sitting in cash and in that in that bucket, I think says a lot. So.
Yeah, well, the other thing too is we have some absolutely massive IPO activity scheduled within the next couple months here, and look, it's kind of like everybody knows that everybody knows these IPOs are coming. All right, like there's no serious investor out there that is not aware that three of the largest IPOs of all time are about to hit, and all at once, right? And part of that conversation is also, well, what does that do to the index, right? So we do know that this is the index inclusion stuff. They're getting fast tracked, so they're going to be part of the indices right off the bat. How does that affect the current holdings of the index? Like, what does that do to the Mag 7? The money that's in the Mag 7, does it have to leave Mag 7 to get plugged into these new additions that are coming in? What effect might that have in the interim, in terms of depressing Mag 7 levels and therefore keeping a lid on the S&P 500 or NASDAQ for that matter? To me, like, the first order, like the level one understanding of this is kind of well understood. Like, everybody knows this is coming. To me, like, the harder question here is, like, what are the effects going to be? Because we all know what should happen to the indices here. But what is going to happen when this actually hits and the flow hits the plumbing and it all plays out? There's a lot of there's people doing some really great research on this and doing some good analysis on it, but at the end of the day, we just don't know yet. And I think that just to take a step back to what you were asking about catalysts before, this is a kind of a known unknown type of a catalyst, right? Like we know this is going to hit, but we don't know exactly how it's going to play out or what's going to happen. And then you could also, like, what if there is a curveball from the Middle East that happens in the midst of this kind of repositioning of indices?
Sure.
Like this is a matter here. We're kind of delving into issues of like national security at this point, right? We
Yeah.
know how important the market is to this administration, right? We've seen the administration pull rabbits out of hats in order to defend the market. I'll put it that way. Like going into the end of March, we went from comments about sending a country into the Stone Age, and the markets really understood and kind of developed a new equilibrium about what that meant very quickly. And then the very next day, we had to kind of, or not we, but the administration had to like completely counter that, because I think that it was very evident what the pricing was going to turn into in a very short order. And that kind of forced this very quick change to the market that evidently caught a lot of the market off guard. They weren't prepared for that. To the extent right now that the market has a more Pavlovian response to maybe being trained not to want to hedge, right? If that happens again, like like
Right.
like if we do like maybe there is a put from the administration right now that means that we don't ever have to hedge again. I mean, the market's basically unhedged right now. I've never seen it unhedged for this long. Like that's kind of a weird thing for me to see. I've been doing this for 20 years almost. Um, um, if we get into a situation where you have these huge IPOs happening and the market is pretty much unhedged as it is right now, there's energy constraints that are happening. I mean, that's a lot of cross currents. It's a tough thing to figure out in real time. Like this is expert mode right now. I have never seen a market look like this. I have seen a lot of other stuff, and even beforehand, like you could point to things that the market looked like, right? The market looked like this environment, or the market looked like that environment. I have genuinely never seen a market that looked like this. This is completely new territory for everybody who's playing this game.
It is very interesting. Just on the on the IPO side of things, I mean, we've obviously got some massive ones in the works, and so that's going to be interesting. And in past times where we've had huge IPOs, right, where everyone knows these are big companies, they're successful, they make a lot of money, they're going public now, and I don't have every IPO in memory, mapped out, but in pretty regular market conditions, we see wild things happen around IPOs, and with a relatively calm, steady surrounding kind of geopolitical market condition in general. To have these IPOs coming in, well, we could maybe consider, and maybe we'll look back at this and say, oh, it was actually very stable and everything was very great. But it does seem a little bit like that's not the case. And to have some of these massive IPOs, and of course, everybody trying to jump on and get their piece of the action, I will be sitting back with popcorn, watching it play out,
Yeah.
and participating zero. Like I never do. I never buy into any IPOs, but it certainly is going to be interesting, and it certainly has the impact or the potential to have a lot of impact on the market. So
Yeah.
So that's going to be exciting.
I remember going back to like 2007, right? And you see Visa hit the tape. Okay, amazing company. Those shares went like wildfire. I recall very vividly clients, not my own clients at the time. I was working with another, I was an assistant back then, working with the corner office guy, and I recall clients phoning, and I'd never seen that before. Clients phoning, they need that IPO. They need that IPO. Okay, so Visa debuts, and that's like kind of top of the market-ish, 2007. I don't remember exactly what month, but I mean, even Visa, one of the strongest brands on the globe, cash flow up the yin yang, is off 20%, almost right off the hop. Like I'm sure people watching this can pull up the charts and see, but memory recalls that thing is off like 20-ish% right off the hop, and it's like one of the strongest companies around. And okay, from there the thing just like went straight line up. It's a great company, right? But I mean, it's just like you remember some of these stories from times where you see these hot IPOs, and not every great company is a great stock in the moment, right? So just something to keep in mind as we see here. And that's not me saying something specific about the IPOs we're about to see next, but it's just me having a very large question mark about how that actually plays out in real time.
Exactly. And will the upcoming IPOs be the ones that don't come off the highs 20, 30, 40, 50% over the following 30, 60, 90 days? Who knows? Nobody knows. We'll just watch and wait and see. But I, for one, never do anything with IPOs, and I just sit back and watch. And I usually have a very calm entry somewhere down the road at a much better price than people fighting to get in the door.
Yeah,
And
I'm a pretty boring guy in that respect. I don't really like doing these super exciting things when it comes to, or super complicated things when it comes to markets, and I feel like these days, especially in like the heat of online discourse, like Twitter, et cetera, and these like social channels, like that stuff gets really, really hot. And people really want you to be the most complex guy on earth. But like tend to be a very boring, vanilla, long only investor, right? I just like for me, when I want to put a lot of risk on, I want the market to be offering like really simple kind of trading setups. Like in 2023, for example, it was like really simple. You didn't have to overthink it. The market looked incredibly cheap, and we went full growth stocks, and we made a bundle of money over the ensuing number of years from doing a very simple thing. And so here we are at what looks like very different conditions, and like far be it from me to try to squeeze the last few drops of return out of a market that already looks like it's in like super late stage. So like, if you guys want to go out there and try to like rotate through sectors and be super active trading and get that last 5 or 6% out of the market at the very, very top, I mean, kind of like be my guest. Because the thing is that's a really, really easy trade to screw up, and then you're down 6 or 7% before you know it. Like some of these stocks, like you could buy a chip stock, you could make a year's worth of S&P return in like a day or two these days,
For sure.
and then that thing can reverse back out on you depending on who else out there is hitting VAR limits and risk limits and volatility limits of all kinds, and before you know it, that thing elevator is down, and then you're negative 5-6% like in another day or two. And
Yep.
like to me, like there's not a lot of upside to trying to play that game. Like I'm just not tuned. The things that I do are not tuned to that kind of short-term trading. For me, that's why I'm just willing to hang back here, let this thing play out, sit on these treasuries for a while. We'll earn some interest along the way. This isn't bothering me very much at all because we've made so much on the way up to here that to kind of sit back and let this play out and watch it unfold for a bit here, like it doesn't like that's fine. I don't need to be making 30 something percent, 40% every single year. Like that's just, you can't do that. And so you have to just accept when that time comes to an end to hang back a little bit and have some patience. And I think that's kind of something that I've seen lacking a little bit lately over the last number of months.
For sure. I think that's great advice. I think the investment advice that we can always just give in abundance is be patient. Don't take on too much risk. That's my investment advice to everybody. Be patient. Have a little patience. So that's great. That's great. I love it. I think those are great points. I'm so glad you were able to join us on the podcast today. I think these are great lessons and great reminders of the kind of markets we're headed into, right? And the more excited people get about things, the more concerned I get about things. So we just want to keep a level head, watch this play out. And tell everybody where they can follow you and see a little bit more about what you're doing and continue with some of these insights.
Yeah, sure. Thanks, Jared. So you can first off get in touch with me. You just type my name into Google. You can give me a telephone call, send me an email if you like. I'm on the company website at Wellington Altus. I'm very active on Twitter. So if you're looking for up to the moment or up to the minute commentary on ideas that I'm looking at, go over to my Twitter. It's Ben Kizemchuk. You'll see my name spelled here on the podcast. Just go ahead and type that into Twitter and follow me there. I think my profile is open. You can send me a chat with me there. I'm always happy to hear what's on your mind and help out.
That's awesome. That's awesome. We'll make sure to post that link with this episode as well, so everyone can just click on it and go have a look and see what you're up to. But I, for one, will be keeping an eye open and see what Ben's up to. So thanks for sharing with us today. Again, thanks for taking a little bit of time to join us on the podcast. Really appreciate it.
Thanks, Jared. It was a pleasure.